Hi everyone, this is a technical analysis on USDJPY. Let's start with some fundamental background first. In the US, the Fed left interest rates unchanged as expected at the last meeting, with a shift in the statement that indicated the end of the tightening cycle. The latest US CPI is likely beat expectations, but analysts expect the core PCE to print at 0.2% month over month following the CPI data. The labor market continues to soften but remains resilient, with US jobless claims beating expectations week after week. The latest ISM manufacturing PMI beat expectations, while the ISM services PMI missed by a big margin. The US retail sales beat expectations across the board. The Fed members recently have been pushing back on the aggressive rate cuts expectations. In fact, the market expectation for a rate cut in March fell to roughly 50%. In Japan, the BOJ kept its monetary policy unchanged as expected at the last meeting, with interest rates at negative 0.10% and the 10-year JGB yield target at 0%, with 1% as a reference cap. Governor Ueda repeated once again that they won't hesitate to take easy measures if needed, and that they are not foreseeing sustainable price increases unless wage growth picks up. The latest unemployment rate remained unchanged at near cycle lows. The Japanese manufacturing PMI fell further into contraction, but the services PMI ticked higher, remaining in expansion. The latest Japanese wage data missed expectations by a big margin, and as a reminder, the BOJ is focusing on wage growth to decide whether to tweak its monetary policy. The Japanese CPI today eased further across all measures, which makes it even harder to expect a rate hike from the BOJ anytime soon. Now, on the daily chart, we can see that USDJPY broke through this key resistance zone around the 146.60 level, where we also had the 50% Fibonacci retracement level for confluence. The buyers piled in aggressively, supported by hawkish Fed's Waller comments and strong US data. The natural target should now be the cycle high around the 152 handle, unless we see a complete turnaround in the economic data in the next few weeks. On the 4-hour chart, we can see that from a risk management perspective, the buyers will have a much better risk to reward setup around this trend line, where we can also find the 50% Fibonacci retracement level and the previous resistance now turned support. The sellers, on the other hand, will want to see the price breaking below this trend line to invalidate the bullish setup and position for a drop back into the lows. On the 1-hour chart, we can see that this latest leg higher diverged with the MACD, which is generally a sign of weakening momentum, often followed by pullbacks or reversals. In this case, we might see a pullback into this recent swing low around the 147.66, where the buyers are likely to step in with a defined risk below the level to position for another rally. The sellers, on the other hand, will want to see the price breaking lower to increase the bearish bets into this major trend line and then target a break below it. Today, the only notable event will be the University of Michigan Consumer Sentiment Survey. The price is already a bit overstretched on the upside, but a surprisingly strong or weak release could trigger sustained reactions.